Property casualty insurers have been able to keep their expense ratios under control even as underwriting expenses have gone up. Here to discuss a new AM Best report on the subject is David Blades, an Associate Director, and Christopher Graham, Senior Industry Analyst, both in AM Best Industry Research and Analytics Department. And David, how has the push to use new technology, implement new technology, particularly in claims and underwriting, impacted the bottom line?
Well, it's definitely had an impact on the bottom line. We've seen, in particular, private passenger auto and workers' comp insurers utilizing, new technology platforms to help, mitigate expenses and lower their expense load. Like you said, from an underwriting standpoint, even from a loss control standpoint, and from a claim perspective. And we've seen that in terms of the impact on the overall PC industry underwriting expense ratio, where it's been going down and helping offset those years where the loss ratio has been higher because of, especially because of natural catastrophes over the last few years, that we've seen some things trending upward, natural catastrophe wise and secondary perils wise. So the underwriting expense ratio going a little bit lower has helped out in that respect. So we've definitely seen that have an impact, from an overall perspective. Underwriting expenses in general, when you're talking, again, claim expenses, loss control expenses, et cetera, they've actually nominally been going up, but because net premiums written has been going up by even more, the ratio, or the underwriting expense ratio, has actually been declining. And I think, we'll look to, probably see that trend, continue as we go forward. There are different factors, that'll play out in there, but I think we'll continue to see insurers, and especially, like I said, in those particular lines that I talked about, put more into, controlling their expenses from that standpoint, and helping their underwriting ratios. Again, they're really trying to hone in on underwriting profits, again, in the years where we've had struggles to make money on the investment side.
Something you and I have talked about, you can't turn on the TV these days without seeing an insurance commercial. Does advertising spend correlate with trends that you're seeing?
Well, in terms of the correlation, I think when you look at the top 5 spenders, and we looked at this in the report, the top 5 spenders in terms of advertising expenses, they are, the leading names that we've seen in the industry, particularly in the private passenger, auto riders and even homeowners. When you're talking about State Farm, Allstate, Progressive, Geico, for Berkshire Hathaway, and even Liberty Mutual. So when you look at it from that perspective, we've seen those companies in particular who do make up like the top 5 in terms of the direct premiums written in the industry, and they've been able to, protect themselves or grow from a brand recognition standpoint, but also protect their market share. So we've seen that trend continue. And in terms of their returns, I think their returns have been favorable from a standpoint. We listen to the quarterly calls for a lot of these the publicly traded companies, and I remember a couple of, let's say the CEO of Progressive talking about the return that they see on their advertising dollar, and they see it as having a favorable impact, and that's just one example on their overall bottom line. So I do think that we're seeing, the correlation there in terms of where they've been able to stay at from a growth standpoint, and what the impact that we've seen advertising have from the standpoint of them being able to maintain premium levels where they have been. So we'll continue looking. It's really kind of an inexact science to try and tie advertising to underwriting profits and operating profits, but from the standpoint of growth, which is a direct correlation to brand recognition and market positioning, I definitely think that we've seen some correlation there.
Chris, marketing strategy seems to have some varying effects. Can you discuss that?
We see that independent agents, or well, let's say it this way: insurers who write through independent agents or MGAs seem to have higher underwriting expenses than those insurers that write through direct response or captive agents. When you think about it, it's really not that surprising, though, because an independent agent is responsible for all the overhead of the office, all the salaries of the staff in the agency, whereas with a captain agent, the insurer is probably picking up some of those expenses. So it would make sense that you would see the independent agencies have a higher underwriting expense ratio than the captive agent insurers.
Now, commissions have historically been a big ticket expense. Is that still the case?
They are. They're still a large share of the underwriting expenses. We did see, at least in commercial auto, we saw the underwriting expenses overall actually drop over the past decade, and that led to some of the improvement in the commercial auto results. But we still see, commission and brokerage being a big chunk of the underwriting expense. Also, with that, we see the compulsory lines have a lower commission ratio than, say, the voluntary lines. Personal auto, workers' comp have much lower commission ratios than some of the other lines, and again, that makes some sense because an insured is really just going to, if they're compelled to buy it, they're going to find an agent, and whoever can place it, they'll do it. Whereas if it's a voluntary line, they're more likely to shop around, and the insurer might be willing to pay a little more commission to get the business.
Chris, David, so glad you could speak with us today.
Thank you, John.
Thank you for having me.
That was David Blades, an Associate Director, and Christopher Graham, Senior Industry Analyst, both in AM Best Industry Research and Analytics Department. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.